Hello, everybody. Welcome to the Santander Breakthrough Smarta webinar. This is the first of our upcoming series of webinars that we're bringing you in support of fast growth businesses. So we're really focusing on the subject of how do we move companies that are entrepreneurial small businesses and give them the knowledge and support they need to fast track their growth and really get to that next stage. So the subject for us today is securing further investment to fund fast growth. So we're really talking finance today, and I've got two wonderful guests with me here. I've Matt Cooper, who is head of business development at Crowdcube, and formerly with Market Invoice, so two very exciting entrepreneurial fast growth companies who absolutely are in that very world of finance. So companies that they're expanding fast themselves, but also really kind of pioneering the growth of others as well. As is very much Darren Hart, who is the head of growth capital with our proud partner Santander. We're going to get down to business really soon and make this a webinar that answers your questions. I'm going to lead the conversation and the debate and really kind of explore the type of finance options that are out there, how you access them, and really how you kind of find the smart money for your business as opposed to any money, and really just kind of look at the kind of the finance options, the mechanisms, the approaches you should be taking to access and grow your business, and how you get hold of the capital to do that. But first of all, I'd like to just introduce our speakers. So first up, I'd like to ask Matt just to introduce himself and tell us a little bit about his background. So over to you, Matt.
Thanks, Matt. I don't know whether I should be Matt 1 or Matt 2.
Yeah, absolutely.
My background, I'm head of business development at Crowdcube. Crowdcube is the world's leading investment crowdfunding platform. It's actually our 4th birthday party today, so we've got a big party tonight, which is fantastic. Yeah, exactly. What do? We enable anyone to invest alongside professional investors in startups, early stage and growth businesses, either through equity or debt investment options. You can do that from as little as £10 right up to hundreds of thousands of pounds. We have a crowd of registered investors now totaling about 132,000 people. We've successfully funded nearly 200 businesses to the tune of about £62 million. So very exciting period of growth for us in a very interesting and exciting alternative finance space, and we speak to a lot of really interesting early stage startup and growth businesses on a day-to-day basis about how to help them grow.
Brilliant. And do you want to tell us a little bit about your background as well, Matt? So stuff that you've done before and perhaps the
sure, yeah, I started a career in investment banking, actually. I spent nearly 5 years with Merrill Lynch. I was a market maker, could make a two-way price on listed stocks. I then got fairly tired of the city and the people in it, and sort of went on a journey of helping to scale up a number of different businesses, both B2B and B2C. Was very proud of my time at a business called the One brand, which was famous for and still is famous for One Water. We gave away over £10 million to development projects in sub-Saharan Africa off the kind of commercial success of scaling up that business. And then most recently, I was, as you mentioned, was a very exciting fintech company called Market Invoice, which provides a very clever working capital solution to growth businesses, allowing them to trade debt or invoices with larger blue chip debtors in order to quickly release working capital. So yeah, that's me.
That's brilliant. Thank you very much. And Darren, could you introduce yourself and kind of especially talk to us about your position at Santander and some of the businesses that you're working with?
Yeah, absolutely. Good afternoon, everybody. I joined Santander, I suppose, about 3.5 years ago, actually, specifically to set up the growth financing part of our breakthrough program, which is uniquely aimed at supporting high growth SMEs across a range of disciplines, actually recognising that that it's a fundamental and critical part of the UK economy and job creation within the UK economy. And the approach that we've taken with this, very much in response to the government's challenge to banks to do more for SMEs, is to look at lending in a different way to how banks conventionally have done it. I think typically there's been a focus on the assets and funding assets, either through mortgages or asset finance or invoice discounting type products. But really importantly, a lot of growth businesses today are not asset rich. A lot of the investment in growth, which does create value, initially can look quite intangible, and so you can't do it on a secured lending basis, but actually you can do it by focusing on cash flow and growth and value creation, and an ability to service and repay debt over time from those established cash flows. And if you can do that without going down the equity route, either private equity or venture capital or business angel, that understandably dilutes the founders, the entrepreneurs' shareholding, then that should be a very interesting proposition. And over the last 2.5 years, we've done nearly 50 deals now. Average size is about £1 million, but we have a very wide mandate. Our smallest deal is only £150,000, and we've got one sanctioned now at the £10 million space. So, interestingly, for a bank, I'm not incentivised around the size of the deal, but the numbers of the deal. So our sweet spot is very much in that young business, not startup, established, but still young and still very much growing dynamically. So my background is in mezzanine finance, which is what our growth capital product is. It's quite simply a loan product, albeit it's priced more highly to reflect the relative unsecured nature of it. And I've been doing that in banking all of my career for the last 20 years or so, with a brief flirtation with private equity in the middle of that. But this is a very exciting space for us, and one that we're committed to.
That's brilliant. Thanks, Darren. I think in the space that we're in and we're talking about with finance, and especially when it's not seed capital, kind of first round stuff, I think there's a kind of an assumption that the CEOs and the entrepreneurs and the kind of people that are listening in will already have the knowledge of exactly what type of finance is out there. But I think that's not always the case, and it is a very rapidly changing environment that we're talking about. So it'd really help, I think, just to cover the basics first before we kind of dig into any more detail. So, Darren, it'd be really great just if you could further explain the kind of types of finance that are available for these kind of fast growth entrepreneurial businesses, and just how it works, really, how you might I guess open a conversation with a business that might come your way that is looking for that next stage of finance, and then perhaps we'll switch to Matt, who can talk to us about how Crowdcube might help that audience as well.
Okay, yeah, sure. I mean, you're absolutely right. There's an enormous range of financing products available, most of them from banks, but those in banks typically don't show the same level of innovation as some of the newer financiers. Crowdcube is very much at the forefront there. There's quite a wide range, actually, of public support, and we ourselves have an affiliation with the Regional Growth Fund through the Department of Business Innovation and Skills, and just this week there's more initiatives being announced there. But I think fundamentally, if you're looking to grow your business, the key thing to establish first of all is what do you need the financing for? Because if you can align that to the right kind of product, then that's a good step in the right direction to start with. And it might be that you need to invest in a piece of kit, something physical, a machine. Perhaps it's an engineering or manufacturing business. and there are asset finance products out there that will do that, relatively cheaply. I think fundamentally where most businesses need to look when they are growing is in the working capital space. Most businesses will absorb cash in working capital as they grow. It's quite simply a reflection of having to pay for your goods or raw materials before you get paid for your products or services by your customers. And if we can look at the nature of your debtor book, your accounts receivable, and align a financing product to that, either invoice discounting or a conventional straightforward overdraft or revolving credit facility, that's a good way of doing that. But you will get to the stage, as I alluded to earlier, where you might need to make investments in people, or research and development, or sales and marketing, or systems, IT platforms. These are typically a little bit more difficult, and this is where you have to start thinking about whether you have a business that will be able to attract an element of unsecured lending, or whether in fact you have to go down the equity route, which has a lot of benefits in addition to the capital. So it's really about establishing what you want to borrow for and aligning one of the many financing tools and products to that. Is that an okay start, Matt?
It is. Thank you very much. And Matt, you can probably then pick up on that point of equity, and also for obviously equity from the crowd side as well. I'm particularly interested to hear about businesses seeking funding for that next round of growth rather than the initial seed capital.
Yeah, I think Darren made a really good point about understanding and figuring out what you need the money for. I mean, we see businesses from seed kind of right through the different rounds of funding, from seed through to angel through to Series A, and for us, it's a really nice growth story to see businesses come back to us for a second and third raise as we've supported them and helped them grow. They're coming back to us for further finance. I think where savvy entrepreneurs start to look at crowdfunding is when they've really nutted out that they need something over and above the money into the business. Often that's the marketing benefit that crowdfunding brings to an entrepreneur. If you imagine you're a B2C business and you've started your marketing plan, you're reaching out to quite a few customers. Doing a crowd round enables you to reach out to a whole lot more customers, and because we allow people to invest, from £10 upwards, you suddenly can take somebody on that kind of growth journey with you. They become very, very loyal. They're less likely to churn because they actually, they hold a share of your business, and that's super exciting for retail investors. You might look at a crowd round because, take Crowdcube for instance. We've got 132,000 registered investments. A lot of those will be senior business people, will be sophisticated investors, and may well have knowledge of the industry that you're in. What we'll often see is businesses actually taking on non-execs or advisors as a result of awareness generated through a crowdfunding round, and that's super exciting as well, that you're actually bringing things into your company over and above just the money.
Brilliant, thanks. So I'd like to move the conversation on to kind of what investment ready looks like. So if you're seeking a significant amount of investment into the company, what do you need to get right first? So, say, Darren, what would you expect to see a business seeking, a couple of £100,000 or maybe upwards towards £1 million? What are you looking for?
I suppose the immediate answer is a management team that is capable of delivering a plan, and that doesn't necessarily mean that they've done it before, that they are a proven entrepreneur, and that they've been around the block and made money. That's not the kind of business that we see a lot, but a management team that have identified a niche for themselves, an idea. They're making themselves important to their customers. That there is some evidence of sustainable sales and profitability and cash flow, and an ability to scale that. So I think there has to be a good level of organisation within the business. There has to be a recognition that there has to be a focus on cash and financial reporting, not just for the benefit of the bank or the other financier, but something that is useful to the business owners, that they get together regularly and look at key performance indicators. So, I think you can categorise this whole assessment into two areas. One is non-financial, the other obviously is financial, and arguably non-financial is more important. What is the demand for the product or service? What are the features and the dynamics of the market in which the business is operating? Is there a competitive advantage that they have? Because ultimately what anybody hoping to back a business is hoping to find is a belief that value will be created, that the business will grow, and ultimately create more jobs and be in a position to not necessarily diversify, but consolidate their position, make themselves more stable, more able to withstand any shocks that come along. And I think that's what we all recognise. Businesses approaching their first serious round of financing are never going to go from A to B in a straight line. That's just not realistic. And much bigger businesses will be able to pull a few different levers to generate cash, and smaller businesses won't necessarily have that opportunity. So, I think fundamentally they have to be in a position where they've thought about all of these eventualities. They can withstand a degree of sensitivity analysis around sales or margins. But fundamentally, just seriously establishing themselves in their markets with a good, credible plan and people to deliver it.
Matt, I think so. I guess that there are two points here with Crowdcube. Obviously, Crowdcube has to vet the number of people, the businesses that would like to be on the platform, and you obviously exercise and examine a number of factors to determine who is accepted onto the platform and who isn't, and obviously you have a commitment to your investors to make sure that you're putting the right type of deals out there. But and I think that probably much of that has just been covered by Darren, so I'd love to hear if there's anything that hasn't been. But then also, if you could just try and talk to us about the deals that really fly and the ones that are oversubscribed. What do you think that those businesses have that perhaps the ones that struggle to get the full subscription don't have?
Yeah, I think that's a good question. Everyone we speak to is always after what the secret sauce is for a successful crowd round, and we've just had one very, very recently with a business called Enclothed that featured on Dragon's Den on Sunday evening, and they funded, I think, £400,000 in 24 hours following that programme airing, and had 1 million Twitter impressions. And we can't always be that lucky that we feature on Dragon's Den at the same time as our Crowdcube pitch goes live. But there are a lot of things that Darren talked about are critical to a successful crowd round. What are we interested in? We're interested in your value proposition. We're interested in what the problem your product solves is, and how will people relate to that? How will the crowd relate to it? Will they relate to the benefits that your product brings? Why would they buy your product and not your competitors? So really kind of nutting out what your written down elevator pitch is. Be really human in how you talk to people. Produce a really amazing video. That's hugely important on our platform. And be really concise in how you talk to people about what your business is doing. There's a couple of other things which really affect the success of a raise on Crowdcube. Set an achievable funding target, really important. start going out to your own customer base early to gauge potential support for a crowd round and potential support to invest in the business. Really work your own network of friends and family hard. Are there people within that network who can support the early stage of that round? Suppliers, are they likely to invest? That's another avenue to really kickstart your crowd round. Have a lot of debate about valuation. It's quite an emotive subject for most entrepreneurs. At the end of the day, we're a marketplace, and the valuation is very subjective. But always be realistic on valuation. That's important. And be clear about what the exit strategy is. Show that you understand what needs to happen in order to get to that exit point, and then ultimately how investors will make a return on their investment. They're probably the key things involved in a successful crowd round.
Yeah, I think that's a really good point on exit, and Darren, and I guess with a very different type of financing, it'd be interesting to know, how far does kind of exit come into it with the bank? Are you interested in that, or how far are you looking ahead?
Well, yes. I mean, I'm interested, but it's less critical because I'm not taking any share in the ownership of the business, and therefore that upside isn't really going to come to me. So, with a mezzanine loan, we have to go beyond security. We have to buy into the growth, but ultimately the level of risk that we take isn't going to be compensated with. Or we can't take a risk that isn't compensated by upside. So I think there's some crossover between ourselves and Crowdcube and other equity platforms, and there will be some deals that I can do where there is an established cash flow that I can see will service and repay debt over time, and therefore dilution isn't necessary. But there will be some deals where the company hasn't got to the stage where it's so well capitalized that a big debt piece is the right thing, where the value creation story is at an earlier stage but is very compelling. Also where there is, I think, a well-known brand or a developing brand, they seem to lend themselves very well to crowdfunding. So I think the approach is slightly different. Some deals will be right for both, some for one or the other. I know for a fact that I've lost one deal to Matt. I don't think he's lost any to me, and maybe that tells you something.
Fair enough.
Sorry about that. Yeah, Matt. One thing I
go on.
I was going to say one thing I probably should mention that can really make a crowd round sing is if the business has the opportunity to blend kind of reward and equity. So by rewards, I mean you might produce slippers. You can offer different types of slippers to different types of investors depending on how much they invest. It might be that you're a craft beer company, and that for investors over £1,000, you deliver them a crate of craft beer once a month for life. We see some really interesting kind of blended equity and rewards programs, and they work really, really well. So if you are a B2C business, that's worth considering quite carefully, and we can help and advise on that.
Cool. Making a deal sing. Can we look at the flip side? So, there's as much as I think we're all in agreement that there have never been so many options available for funding. You still hear plenty of conjecture about not being able to access funding, and the talk of still being a funding gap. I'm not sure that we're going to tackle that subject on this webinar now, but what I think we can do is to look at the reasons why businesses don't access the finance that they believe that they should. So it'd be really interesting to hear from both of you what you think that the kind of proposals that are put in front of you that you have to reject or turn away or don't fly. What were those businesses doing wrong, and what should they be doing to put that right and make themselves a more appealing option for investment.
Shall I go first with that?
Yeah, I think so.
Yeah, go for
it. It's very unusual for me to look at a proposition for financing and turn it away because I don't think the business is very good. You know, I'm in a very fortunate position in that, you know, I see a lot of great businesses, and that's what makes my role here at Santander such a joy. It's really establishing whether we are the right product at the right time for that business. And I'd probably suggest that the reason why most of the deals that we don't seek to pursue are turned away is probably because they're just a bit too early stage. Maybe the track record of profitability and therefore cash generation isn't quite so established. Maybe the businesses are a bit light on capital, and you know, as a bank, we'll always look for some share of contribution to a growth plan. So it's not that the businesses aren't very good. It's just getting the right product. Now, you know, that's not to say that there won't be some businesses that you know, fundamentally shouldn't be looking to you know, take on lots of investment, either leveraging up with debt or with equity, and that's probably going to be just quite naturally the flip side of all of those characteristics which Matt and I covered just a few moments ago. You know, if we don't think that fundamentally there's an ongoing sustainable demand for the product or service, if the market is looking as though it's very crowded with lots of new competitors entering, very low levels of repeat revenue, high customer attrition, management teams that are thin and don't have you know, either the experience or the confidence to deliver the plan. There are lots of reasons, but it's not necessarily that the business isn't good enough.
Brilliant. Matt, anything to add?
Yeah, I think you know, right product, right time is also important for us. We see businesses at all different stages of their growth cycle. You know, we're actually making it easier for businesses to work with Crowdcube on kind of sub 100,000 SEIS rounds. So removing the barriers to entry to getting a pitch live on the platform, because we recognise that actually that's where we started. You know, to support entrepreneurs who couldn't access finance anywhere else. And you know, I'm passionate about the alternative finance space. It's something we did at Market Invoice. It's what we do at Crowdcube. But we still have to turn some businesses away. It might be that they are actually too early stage, and that we say come back in, you know, even come back in 6 months when you've developed your proposition a little bit further. We're a success-based business, so we only succeed if pitches on our platform succeed. So if we get a sense that an entrepreneur is not willing to work hard at their pitch in partnership with us, we'll sometimes kind of send them away and say, you need to free up some more time to commit to this. This isn't, you know, you don't just sign up to Crowdcube and then win everything. It's a lot of work to do a crowd round. You need to manage. You need to promote your own events. You need to go to all of your friends and family and try and get them on board. How are you going to invite them? You know, how are you going to use your networks, your contacts, your customers, your suppliers? What's your social media strategy to promote the crowd round? You know, have you engaged a PR agency or some sort of PR support and done a press release around it? It's kind of can be all consuming, and sometimes we'll get a sense that people aren't quite ready for that. You know, maybe they've got too much going on in their business currently, and that may be why that can delay things at times. But no, I think the main advice is if you make the decision to do it, you really need to commit 100% to it, and you know, we'll go full bore on that journey with you, but it can be all consuming for an entrepreneur for the period of time that the pitch is in preparation and then live.
I think that's a really interesting point, not just from a crowdfunding raise, but in general as well. And I want to quickly talk about equity finance other than crowdfunding as well. And just to give context for everybody listening in, probably my experiences of this is with Smarta. So I've been involved in a raise that we did initially for seed capital, and that was a combination of advanced sponsorship that was non-equity, then some small private investments, and then a second round, which was 2.5 years later, where we went for, I think we did a round of 1.1 million, and that was for some notable investors, so the Epiphytus Debromedon, and then some of the high net worth individuals. And the point I'm making there really is that it really was, as Matt was saying, all encompassing for the management team there, and to the point actually that we underestimated how much time it would take from us running the business, and we actually took our eye off the ball probably for a period of 2 to 3 months where we were just busy raising the money and kind of doing the documentation, the paperwork, the getting out, seeing all the potential investors, then closing it all at the same time, getting everything kind of sorted. And I think that's something that people really underestimate, just don't see, and think that it's something they'll deal with at the time. Darren, do you see that from your side as well? Do you think people are underprepared for how long it actually takes to kind of get and close a round, and how far ahead should they plan for it?
Yeah, I mean, I think the story that you tell, Matt, is one that all entrepreneurs that have gone through a growth financing round will also tell, and probably would be surprised by. And that must be the case whether it's an equity raise or a debt raise that looks more like an investment. The amount of time that it takes is very considerable, because ultimately, you will know an awful lot about your business, and you have to get that information over to the potential funder who's either lending or buying in. So I think it's not typical in this segment to expect businesses to have advisors to do a lot of that work for them. That's very expensive. It's not typical to expect them to have a very comprehensive, glossy business plan that just gets circulated around. A lot of the work is sort of people to people and conversations and explorations around all aspects of the business. So I think it's common to all of us, but it has to be expected, because fundamentally for me, if I'm going into a credit committee looking for a sanction to support a business with a growth capital investment, I have to be that business's biggest advocate inside the bank, and I can only do that if I understand as many, if not all, aspects of that business as possible.
Absolutely. And do you often find that
point of...
Yeah, go on, Matt. Sorry,
Matt. You go ahead. No, I was just going to say it's a really good point about being the biggest advocate when you're kind of presenting it to your credit committee, and we have the same thing here. We have an experienced business development team in London and all over the UK, and they get to know and love the entrepreneurs, and during that kind of get to know you period, in some cases it can take 24 hours, in some cases it can take 24 weeks. It's however long it takes to get the entrepreneur comfortable that a crowd round is the right time. And then, it takes a lot of hand-holding through the process. It's not complicated, but there are certain gates you have to move through. And going out and raising money is a full-time job. And our big success stories, we see them raise their kind of, perhaps they raise their seed round, and then 6 months later they're back talking to us because they raise another round because they've grown so quickly, and it's really exciting for us to go on that journey with businesses like that.
Yeah, I completely agree, and I think for me, companies that are in this fast growth stage just need to be thinking about their finance options at all times, and I almost feel that in the same way that you kind of nurture an audience or a customer base, you should be nurturing all your potential investees, whether they are anything from crowd to bank, debt, equity, private investors, and maybe even VCs at some point. Because I was chatting a while back to Luke Hakes from Octopus Ventures, and he said to me that he hadn't made an investment for a year in a business that he hadn't known for 6 months, and so it really just shows that it's not just a case of knocking on the door when you need the money. you should be building those and fostering those kind of relationships and partnerships, but also thinking ahead in your own business for when you're going to need the money a little way down the road. And I think that's the kind of the best way for you to be prepared and ready to access it and be in shape when you need it. Is that something you guys would agree with?
Absolutely. I think from our side, you talked about kind of maintaining and growing a network of whether it's high net worths or angels or particular types of investors. When people come to us having made the decision to do a crowd round, one of the key parts of successful round is having some sort of cornerstone investment. It's very difficult to start a crowd round from zero. The investors tend to like to follow an investment, not be the first. There's quite a lot of psychology involved in crowdfunding. And if you're out having those conversations and maintaining those relationships all of the time, when you come to the point where you're ready to do an equity round, crowdfund or otherwise, being able to call on those relationships and say, we're raising now, and point them to something is hugely valuable, because they can form the cornerstone, even in a small way, of that equity round.
Darren, anything to add on that?
Well, I'd certainly agree with all of that. People often ask me, how long does it take to do a deal? And there's no common answer to that. Generally, it takes longer than people expect, and that's not because anybody sits on their hands. It's just because it's quite right that we all engage with each other as stakeholders in the transaction at an early stage. So, my team will very often go out and meet prospective businesses, talk to them about their growth aspirations. They'll say, that's very interesting, we'll think about it and come back to you, and then a few months will pass, and they'll say, well, we've refined our thoughts a bit, but we just want to maybe get this cornerstone contract in place, and then a few more months will go by. But that's how we get comfortable with businesses, by getting to know them. None of the businesses that I work with, if we phone up and say, can we come and see you again, say, no, we've had enough of you, they say, well, that's great. We've not known this level of interest from a bank before. But I think that's because, we're approaching things in a very similar way to Matt at Crowdcube and other institutional investors, as opposed to being a secured lender. So yes, timing is everything. It could well take a while. That's not to say none of us won't work quickly if that's what's required, but it's nice to see a level of forward planning and anticipating what future needs might be, because anything that needs to happen on a knee-jerk is not going to instill confidence.
Absolutely. Guys, everybody send their questions in. We've got a few that have been sent through to us via Twitter and email, but there's a questions area that you should be able to see on your control panel. So please do ask some questions now, because I'm going to start putting these to the guys, and I'll answer anything that's relevant from my experience as well. So get typing those questions. We've got a couple already, as I say. So the first one is a really simple one from Jacob, and he asks that how do investors, be it bank or any other type of investor, expect to see a proposition? So how should you put it together? I guess he's talking about if you're not face to face, or if you're presenting, maybe even. So what do you guys like to see first? A deck, a report? How big? How short? What's the best way to do it?
I generally say, yeah, okay,
yeah,
go on, Matt.
No, sorry, Darren, you started. Go for it.
Oh, okay. I mean, I generally say, whatever you have that will introduce your business, and I said a few moments ago, it's probably not going to be a detailed, glossy business plan, and that's absolutely fine. It might be a PowerPoint presentation, it might be your website, it might be a telephone conversation, but ultimately, there's no better way to learn about a business than face to face. And I think, if we have any sense that that there's an opportunity to find some common ground with a prospective customer, then we will go out and meet them and walk around their premises and see their staff and talk to them and look at what they're doing. But that initial contact, doesn't need to be formal.
How about you, Matt?
Yeah, I'd echo that. I mean, we were a business built by entrepreneurs for entrepreneurs, and that face-to-face element and learning and understanding the business, the proposition, the pain points it's dealing with, and kind of the personal motivations of the entrepreneur are really, really important. When we get a little deeper into it after that sort of get to know you period, what are we interested in? We're interested in really a kind of a fairly basic 3-year financial forecast, something that kind of gives a clear picture of your financial position in a way that our investors would understand it. We're interested in a business plan of some sort. This doesn't have to be 50 glossy pages. It's just you kind of the idea, the market, and the people involved. Interestingly, most of our investors on the site will make certainly at the retail end, will make an investment decision just looking at your video and kind of your pitch text. So without delving any deeper into the business plan. So it's really all about injecting some emotion into your video. Don't just sit there and read your business plan off a PowerPoint. If people wanted that, they can look at your business plan. You need to try and capture the hearts and minds, and that's where we see businesses are more successful.
Okay, brilliant. We've got a question.
I like the idea of a video. Yeah, I haven't seen any application by way of video yet, and I would like to. Maybe it's only a matter of time. I didn't mention numbers in my preamble. I suppose that's because it shouldn't be where we start. It should be about management, product, and market, those non-financial areas. But inevitably, it's not going to take us very long before we start showing an interest in the numbers. And so, that's where it's nice to see a degree of preparation. But it shouldn't be anything necessarily that isn't important and of use to the management team and the owners and entrepreneurs behind the business itself. There has to be a plan that everybody buys into, and so that can be worked up in conjunction with us. We can help with that. We don't own the numbers. We're not advising in that sense, but we can certainly share the experience that we have from talking to a lot of other businesses in a similar position as that plan starts to evolve.
That's really interesting, I think, Darren. I think it's an interesting insight that crowdfunding does tend to be a really visual kind of buy-in for the emotion of getting someone to believe in the concept first, and then I often think it's do the numbers and the business model stack up afterwards. But perhaps there's a perception then that businesses need to kind of come with the numbers first with a bank, and I guess that's really changing because ultimately you're looking for the same thing. So people that are coming to the bank looking for investment should absolutely be trying to win kind of hearts and minds as well first and capture imagination.
Yes, absolutely, but I don't think that's unusual with entrepreneurs. That's why they're doing it. It's not an easy job being an entrepreneur. It can be lonely, it can be worrying. I personally don't have to worry about whether I can pay the salaries of my team every month in the same way that they do. So there has to be something inbuilt, some passion, some belief, and that always comes through. And we will be influenced by that, absolutely. So yes, numbers are important, but they do come secondary, because I think we all instinctively know which are the businesses that we want to try and help, that we think are the right ones to try and help before we ever get into financial modelling.
Okay, we've got a go on, Matt.
No, I was going to say we're exactly the same. It's we're interested in working with fun, cool, smart, driven, entrepreneurial individuals, and if they're kind of all of those things, the businesses tend to be ones that might appeal to us to list on the site. So yeah, the numbers are a little bit deeper further in, but it's all about the individual, and do you capture our imagination and our attention first up.
Okay, brilliant. We've got one of the oldest questions ever used in these debates now, and it's one that I've heard rumble on before. So we'll definitely get both of your takes on it. This is from Paul. He says, should you raise what you need or raise what you can? So we'll go with Matt first.
Good question, and you're right. It does come up quite a lot. I think we would always suggest, as I mentioned earlier, setting a really realistic initial target. It's much better in a crowd round to be at kind of when you're at 70% plus on the progress bar, and the progress bar is very important to a pool of very large investors. You'll find things accelerate very, very quickly. So it's much better to set a realistic initial target and then give yourself the option to overfund. You can cap that overfunding, but we would always suggest setting a realistic target. That kind of what's the minimum required to make this worthwhile, and then you can look at overfunding after that.
I guess in the pitch stage, if you can get more, should you take it?
Yeah, I mean, we on the site at the moment, we've probably got 5 or 6 deals which are in overfunding. Some of them overfunding by 50 or 60%. And yeah, I think if you're growing quickly, you should take the money. It's also a larger engaged investor base, so you're not probably going to suddenly turn those people away. But the really, really important thing with crowdfunding is to set an achievable initial target, and blow through it, and then you've got an amazing success story to talk about.
Great. How about you, Darren? What's your take on this one?
I think largely the same. There will be businesses that will always turn excess investment into value. But if I come at this from my own personal perspective as a debt provider, it's rarely a good idea to take more debt than you need. It costs interest. You'll have a different set of financial covenants that you have to adhere to. It has an impact on your balance sheet. So, I think you have to find the right fine line between having enough to deliver your plan and having enough headroom to withstand some crosswinds if they come. So there are a few companies that will come to me and say, how much will you lend me, as opposed to this is how much I need, and I'd rather know what the need is and work to a plan. And I think whilst I say that, we do recognise that whatever the plan is, the reality will be different to it. But ultimately, it is the plan that we are backing. And whilst there will be some flexibility, we're not going to want to see an enormous divergence from that. So within the plan should be a level of investment that's required to deliver it with enough headroom, and that's the approach that I would much rather see.
We're obviously talking about the money that you can access, and we're looking at different types, but could you both objectively just give me a view on how someone makes an assessment of what's the smart money for them? So for me, there would be factors around the kind of the structuring of it, the type of finance, and probably also the if it's an investor raise, then the investors that you're going to be working with. So it'd be great from both your positions to give us a kind of a view on how you think a business in the position that we're talking about takes that step back and figures out exactly what's smart money for them. Darren, do you want to go first on that?
Yeah, I mean, I think if you compare debt and equity, whatever the form of debt is, the principal difference is around the dilution that comes with equity. So you need to make sure that you're getting something for that. Equity isn't just about capital, it's about who are the individuals that you're bringing into an association with your business. What extra non-financial value can they add, and that might be something that is really important to you, because you're probably doing something that you've never done before. If you have some sector experience in your investor base or at board level, then that can really make an enormous difference. If you've got that already, and some businesses, even relatively young ones, will have some real value-adding non-exec directors that are associated with them. Maybe they've been early stage seed or angel investors. Then maybe that's less critical. In which case, look at cost of investment, opportunity cost. You need to make sure that what the money delivers for you is a very compelling return on the cost of that investment. And generally, equity is more expensive, but for the reasons that we've gone through already, might well be the right thing for you. And within debt, all of the different products that are available that align to what it is you actually want. But generally, investment for high growth is probably more along the intangible lines in terms of balance sheet. So, it is going to be cash flow, mezzanine lending, and equity of one form or another, which is most likely, I think.
Brilliant. And Matt?
Yeah, I think it was a very good point about what are the non-financial benefits that bringing an investor or a lot of investors into the business through a crowd round might have, and really that's up to the entrepreneur to work that out. I think the kind of the marketing and PR benefits, if you're a B2C business or B2C brand, they're pretty easy to see. Somebody can work those out quite quickly, and there are many success stories about B2C brands that have gone on and successfully done a crowd round and layered on a load of new customers and very loyal, sticky customers at that. But if you're looking to bring something other than or something non-financial into the business in terms of experience and non-exec, somebody with sector experience, that kind of depends on what stage your business is at and how big your network is. I think during that growth phase, it's important to have that kind of sounding board, that expertise, even if it's in a non-official capacity, involved in some way, shape or form. And a crowd round can be a good way to attract those types of individuals to your company.
Great. I've got two more questions, and I think we're going to have to wrap up because we're running out of time. So if we can, just in case a couple of questions come through right at the end, guys, this is probably your last shout to get some questions today. We have one from Alex Garces, who asks us about valuation. So how should he go about valuing his company? Are there any online tools available, or is there the most credible way to value his business?
That has to be one for you to start with, Matt, I think, doesn't it?
Yeah.
Oh, yeah, sorry. I mean, it's I think we touched on it earlier, but it's valuations are quite subjective. We wouldn't do the sort of due diligence on your business that a VC might do, for instance, but we're looking to try and kind of validate all of your claims. In terms of valuation, setting a realistic level is all important with a crowd round, because setting it too high, you're not going to get any interest in the investment to start with, and also it can cause you problems further down the line. So our advice is always, if you're coming to us, come to us with a kind of a realistic expectation around the value of your business, and we'll enter into a debate with you about that. We have a team of investment specialists based at our head office in Exeter who can do that. We can reference what past successes we've had on the platform in the particular sector that you may be in, and that can give us a sense of whether it's a real outlier in terms of valuation. And on occasions we will turn a business away because we can't reach agreement on that. But normally we come to an agreement and we can move on from there. But it's often a point of discussion.
Brilliant.
I suppose from my point of view, it's much more rarely a point of discussion because as a bank we're not buying in and therefore don't really need to have the business valued. We might be interested in a sense of what we think it's worth, but it is very difficult, especially in this segment. There's no right or wrong answer. I think if I was trying to think of the wrong ways to do it, it's probably discounted cash flow and multiples of profits or multiples of sales. I think the best way to do it is the way that Matt can do it, and that's benchmarking against a whole lot of other businesses of similar size and similar sectors. That's the only really reliable way, but ultimately it's down to investor sentiment. So, if you are going down the route of bringing in an equity investor, that's the kind of place to look, I think, as far as possible. But there aren't so many sources available. It's a tough one.
It is a tough one, and if the other thing to consider is if you have an investor, angel or otherwise, who's willing to make a commitment as part of a crowd round, then the rest of the crowd round will be at the same valuation. So there's an element of kind of a bit of a safety net for us, if you like, that if we know that whether it's institutional or a seasoned angel investor is willing to make an investment at a particular valuation, then that's also can be a good starting point for us to in discussion with the entrepreneur.
Absolutely. We're just about to wrap up, but we've had a question from Sarah Hill on Twitter, and she's asked us, are we directly able to give feedback on decks? I guess you can all answer individually, but I think it's an interesting topic anyway of what's the best way to start getting feedback on your kind of investment proposals, and when should you start doing that, and who should you do that with? So, Darren, do you want to answer that first?
So the question is around feedback on early investment proposals and the way they're presented, do you mean?
Yeah, so Sarah's definitely actually asked the question if you or I or Matt could give her feedback on an investment deck, but I think if we feel free to answer that way. But I think if we tackle it in general for everybody, of how should people go about getting that initial feedback?
I think all of us in this business are going to be quite happy to engage with companies at relatively early stages and plan towards an ultimate investment, whether it's debt or equity, over the right period of time. So I'm sure we're all quite happy to give feedback, because it should be obvious to us which areas of the proposal are perhaps a bit thinner than others, just by virtue of the number that we see and the experience that we have of knowing which ones are successful or otherwise. So yeah, I wouldn't shy away from that. I don't think there's a need to hold back too much until you make that first approach. But probably one of the other points that's relevant here, and I was going to make it earlier, is find some mentors, do some networking. There's lots of groups around in every area. People will have gone through this before and have some really good pointers, and people generally are very happy to share the benefit of their experience.
Matt?
Yeah, I'd agree with that. I think having mentors and more experienced eyes look at a deck is a good idea. We're set up as a business to kind of hold your hand through the process from initial sort of get to know you right through to getting a pitch live and successfully funded, and a lot of that is in a way business coaching around getting your pitch text right, helping you with your video, looking and critiquing your market plan, your marketing plan, and we have the infrastructure in order to do that. But I would say to anybody who's thinking about what's the right method to raise investment, is just pick up the phone and reach out to us, because we like talking to interesting businesses, and not all of you will be right for us. But we're always happy to have a conversation in the first instance, and then take it from there.
I think that's great advice, and certainly from my point of view, that it's all about networking and talking to people. So you should be getting out there and about, trying to build contacts such as you guys, and people that have either gone through the experiences before or are able to give you some kind of initial feedback, so you can just start building a story and a case around what you do. And certainly for me as well, speak to your bank manager. So even if you're not networked, you don't know anybody else who's raised finance, you don't know anybody in that kind of space, everybody's got a contact at the bank, and just kind of get their feedback, even if ultimately that's not the finance that you're going to go for. So I would always turn to that as a great source of kind of advice, really. We do have one more question, so I'm going to ask Nima's just plonking it in front of me now, and it's from KR, and it's around Series A and B crunch, and sorry, I'm just trying to read this question out. Okay, so it's around Series A and B, and how should you plan for first and second rounds of finance, or should you be already planning the second round in the proposals for the first, or do you keep that separate? Darren, do you want to go first on that?
Yeah, I suppose it's quite a difficult one. Every case is different, isn't it? I mean, I think in general, I would say, don't necessarily complicate one with the other. It's going to be easier to do a second round of finance on the back of a successful first round one, and if you're going down the equity route, then obviously you'd expect to do that second round financing at a higher valuation than the first one, which is as good an argument as any to defer it until later rather than doing it all in one go. But ultimately, as a good entrepreneur, you will have an eye on the future. You will be looking forward and anticipating what the opportunities are that you can exploit, and what kind of finance you're going to need for that.
Matt, anything to add? You must get people kind of asking you whether should you go for the first round or then be planning the second. How do you guys handle that? What advice do you offer?
Yeah, I think we touched on it earlier. It's when you're getting into that kind of Series A and beyond, it becomes a bit of a full-time job, and the entrepreneurs we speak to have always got an eye a little bit further down the road. What we're increasingly seeing is businesses that are at that stage of their kind of funding journey and are growing quickly. Are often engaging with VCs and institutional money to invest alongside the crowd. It works quite well. The VC gets validation on the product or idea, and the crowd get to invest alongside a much more seasoned investor, and follow a much more seasoned investor. So we're seeing those increasingly. But yeah, I mean, from our point of view, when you get to that stage, most of the entrepreneurs we see are have always got an eye on a little bit further down the line, and Series B and so forth, or have people in their business that are looking after that anyway.
Brilliant. And if we could just wrap up with your kind of each of you just giving your one piece of advice to everybody listening in who may be in that position of thinking to access that finance for growth. Matt, do you want to go first, and then we'll finish off with Darren?
Yeah, I think kind of the biggest piece of advice would be to just get out there and hustle. Really work your networks, go to a lot of events, talk to lots of different people, and don't be afraid of approaching whether it's an alternative finance provider like Crowdcube or a big bank like Santander. We want to talk to you. We want to help. We're interested in your businesses and being interested in your business and how it grows. so just pick up the phone and come and talk to people. And yeah, I guess that's the advice from me.
Brilliant. And Darren, if you'd just like to wrap up for us.
Well, I think that's very good advice. I'd almost, not flatter myself to offer advice to people who are, doing the brave thing of being an entrepreneur. The advice that we gave ourselves as a bank a few years ago was, be much more open-minded about working with other financiers. And so, we talked just a moment ago about first and second round financing. The first round might be equity, the second round might be debt. We haven't done anything along the investment piece with Crowdcube yet, and we need to be open-minded about doing that and finding the right solutions for our common customers and opening up ways of working together. So that's the challenge that I have for myself. That I think the advice for entrepreneurs is, work hard but enjoy it. Talk to us at an early stage, because in all honesty, that's the best bit about our jobs, talking to you and trying to kind of have a bit of your passion rub off on us, and we really look forward to that.
That's brilliant. Thank you very much both for joining me today. I think it's been a really kind of a really good and enjoyable and knowledgeable chat, actually. Certainly I've learned a few things that's kind of changed my thinking. Hope everybody that has tuned in has enjoyed it. We'll be sending you an email of where you can access the webinar online, so you can go back and listen to anything again if there's something that you've missed. We'll also be sending you links of how you can get in touch both with Santander and Crowdcube, and we'll send you an update of all future webinars and physical events that we'll be launching as part of this program. So on behalf of Smarta and Santander Breakthrough Program, just like to thank both our guests and everybody that's joined us today. So thank you.